Hey, it's Mike Curtis with Trader's Edge. In this video today, we're going to teach you more about market corrections, what a market correction is, and how they happen, usually on average once every year. So it's something you need to be prepared for as a trader and an investor. So enjoy.
I thought what I would do, because yesterday we officially met the definition of a correction, and I just want to go over that again. What is termed a market correction? Are there stats on how often they happen? Are there stats on how often they last on average? Okay, the answer to all that is yes, there's a definition. Yes, it happens at a certain average length of time, and how often they happen. So all of that, yes, yes, and yes. So the market correction definition is when there's been a 10% decline from the 52-week high. Okay, and we wouldn't be talking correction if the market wasn't going to highs, right? We're assuming that the market's running and it's making new highs. So the high that this is the S&P 500, the highest point it got to, right, on that day, if you look at this box, it got as high as 33.93. Let's just round that to 3,400. Okay, so 3,400. So a 10% correction, 10% of 3,400 is 340, right? Just take a decimal over. So 3,400 dropping by 340 is about 3,060. That's a 10%. So you can see this 30-40 right here. We hit the market's the definition of a market correction, 10% off the highs. We hit it right here yesterday, that day. Now we're here. There's people expecting a big bounce up higher today. Like, hey man, we've suddenly done this 10%. And are we going to bounce at some point? Yes. In fact, it might be later today. It might be some kind of a capitulation day today. We don't know. We just got past the first hour. And these can happen in the last hour. They can happen midday, where it's just this pivot and all of a sudden we just come back with a vengeance. Not all the way back up here. Okay, so let's talk about how often corrections happen. And since World War II, we've averaged what's a correction? A 10% retracement off the high. We've averaged a correction once every like 357 days. Just call it a year. We've averaged a correction once a year. Now keep this in mind, since 2008, that interval has been a little longer. So and that kind of makes sense, right? We went through the Great Recession of 2008, the housing meltdown, all of that. And I think once the buying came back in, that was such a rout that the market didn't need to belch out, these corrections as often. And in fact, it hasn't been that way. So the last correction we had was at the end of 2018. We didn't have one in 2019. So we've been about 15, 16 months since the last correction. So something was bound to happen, and especially how crazy and bullish this recent run was. And I got into some shorts. I got into that VIX call spread, the shock absorber. I was buying the QID right as this big gap down and this break and these bigger ranges were happening. I'm like, you know what? We're probably not far from a correction. And I figured it was just going to start right here. And so when it took off and was gaining new highs, I was just patient with it. I'm like, I'm going to keep them on. I'm going to keep on the VIX call spread. I'm going to keep on the QID, and they're obviously paying off in spades right now. So the VIX call spread, but I use the ticker VXX. Being that it's a spread, it's only going to give us profits for so far because we only make money between the spread.